All right. Happy Wednesday, everyone. Welcome to Navigating Student Loan Debt and Public Service Loan Forgiveness. We have folks that are trickling on in. The participant list is going up. We have about 50 folks that are signed in, but I know we have over 200 registered for this webinar. So I'm going to take my time with the housekeeping and introductions. That way we can let folks get in and participate. So thank you all for being here today. It's always great to be in community and learn with you all, especially when it's about a topic that is frankly clear as mud that even me as someone who is in the public service loan forgiveness world sometimes really doesn't know what I'm doing or what's going on. So I'm really, really honored and really, really happy to be able to bring this training to your front door, and very, very thankful to our speaker, Michael Lux, and also to our co-host, the Public Interest Law Section of the Florida Bar, for making this happen. So quickly, some housekeeping. Live transcription has been enabled. You should be able to see that at the bottom of your screen. If not, there's an option to click either live transcript or more and press show subtitle. If you have an issue with that, reach out to me in the chat and I'll try to help you. Speaking about chat, it looks to me like the chat is enabled. I did have an issue with my chat being disabled in one of my previous webinars. So if I'm going to troubleshoot and chat everyone and let me know if it's working. But if not, head over to the Q&A and just let me know that the chat's not working, and I'll do what I can to make that happen. Third, housekeeping. This is approved for one general CLE credit. At the end of the webinar, I will provide that CLE code for you all. And this is being recorded. So folks, yep, chat's disabled. All right, I'll work on that. This is being recorded. You will receive a copy of this recording within 24 hours. That email will come from Zoom, and it will have the CLE information, the recording, any resources. That way, if you have to drop off early or you miss part of what's going on, you'll be able to learn on your own time with that recording, those materials, and the CLE information. So last housekeeping announcement before introductions is questions and answers. So I was going to ask you all to put your questions and answers into the chat. Given what's going on with the chat, until I enable it, I would ask that you put it in your questions in the Q&A, and I will write into the chat when that issue seems to be resolved. But please put your questions into the Q&A. And that way, I will do my best to interrupt our speaker at an appropriate time to ask your questions contemporaneously in live time. That way they can be tied to the subject matter. If that question does not get asked during the time that our speaker is speaking about the subject, don't worry. He has graciously agreed to stay on, answer any questions you might have after the presentation. So long story short, put your questions in the Q&A. We will get to them one way or another. So with that all being said, I'm going to move into introductions. So today we have our wonderful speaker, Mr. Michael Lux. Attorney Michael Lux is the founder of the Student Loan Sherpa. He has educated borrowers through the site since 2013. Student loan expertise from Michael Lux has been featured on the Wall Street Journal, Forbes, US News and World Report, CNBC, and numerous other online and print publications. He is licensed to practice in the state of Indiana and is a graduate of the George Washington University School of Law and the Ohio State University. As a former homicide prosecutor, Michael knows how to get the attention of an audience and convey complicated information in an easy to understand manner. Though student loans can be both dull and stressful at the same time, Michael strives to keep his audience entertained, engaged, and most importantly, empowered to get their student loans under control. And so if that introduction doesn't already show you how lucky we are to be here and to have Michael with us today, you will see throughout this presentation how lucky our legal aid community is to have him here with us. Thank you so much, Michael. The floor is yours.
Boy, that was some introduction. I will try and live up to half of that hype. Thank you all for being here. Like Lexa said, I will be available at the end if you have questions, and you can always reach me through the Student Loan Sherpa if you have questions at any time in the future. As she said, the site was created in 2013. When I got out of law school, I was a prosecutor and desperate for public service loan forgiveness to work for me. And at one point, I found myself searching through the Code of Federal Regulations, trying to figure out the nuances of PSLF. And I realized that there's something wrong with that. You shouldn't need a legal education to pay for your student loans. So I figured I'd, put up this website to share what I found with other people. And as the site grew, we had some mission creep, and now I cover pretty much all facets of student loans. All right, so today I have you for an hour. There's a lot of topics to cover and a limited amount of time because I'm dealing with a group of attorneys. My goal here is more issue spotting than anything else. I want to put all the relevant things on your plate and give you the tools to manage your own student loans. I can't talk about every conceivable circumstance. I can't talk about every issue that might come up. I can't talk about all of the fine print. There's just not time for that. But we're going to hit all the major topics, especially if you're pursuing public service loan forgiveness. Think of this as a triage session. I will highlight the things that you need to act on immediately and some of the stuff that can kind of take a backseat. The first question, whenever anybody approaches me with a student loan question, the first question is always that I ask is, do you have federal loans or do you have private loans? That is the biggest divide in the world of student loans. Most of what we're going to talk about today is federal loans, but many of you I know have private loans, so I will cover some private loan topics. Broad overview, private loans are not eligible for forgiveness. Any of the headlines you've read about, possible legislation, possible relief, almost never applies to private loans. You're going to have less repayment options, less flexibility, and use different repayment strategies for your private loans. If you're trying to find your private loans, the best way to track them down is actually your credit report. It's not an elegant solution, but it's probably the best way. Now, federal loans, we're going to see a lot of borrower protections. Forgiveness enters the equation. We do also have to deal with the government red tape and constantly changing rules. But you're going to find some relief for your federal loans, especially because you're working in public service. Now, if you have any questions as to whether or not your loans are federal, go to studentaid.gov and you can pull up a list of all of your federal loans. If your loan does not appear on that list, it's not federal. And one other thing to keep in mind, you can't distinguish loans based on who the servicer is. For example, a lot of you have MOHELA loans. MOHELA could be a private loan or it could be a federal loan. They handle both, so you need to find an alternate means of determining what type of loans you have. All right. Now, federal repayment plans. All federal repayment plans fall into two buckets, balance-based and income-driven. I'm not going to spend a terrible amount of time on balance-based plans just because they aren't eligible for public service loan forgiveness. They're not going to get you where most of you want to go. Very quickly, the standard repayment plan is the 10-year repayment plan. So if you're getting one of your first student loan bills, out of law school, that is probably going to be for a very large bill, and you don't have to pay that much. By statute, the 10-year repayment plan is the standard one, but it is not the best choice for the vast majority of borrowers. There's also graduated repayment, where every 2 years you pay a little bit more. That's over a 10-year period. There's extended repayment, where they stretch repayment out up to 25 years. And then there's graduated extended repayment, where you get 25 years, and every couple of years it goes up. The important takeaway here is the only balance-based plan that's eligible for public service loan forgiveness is the 10-year plan. Where that becomes important for PSLF people, if you're worried that after 9 years, IDR will no longer work for you because of a higher income or because of a dwindling loan balance, you can jump on the 10-year plan for that last year and then finish your public service loan forgiveness. If you want to estimate, how much you're going to pay on each of these plans, the Student Aid website now has a tool called the Repayment Estimator. A couple years ago, that tool was garbage. It did not do a very good job of estimating payments. It's much better now and more reliable for predicting what your payments might be on the various plans. IDR plans. Every single one of these plans will be eligible for public service loan forgiveness. The way they calculate these payments, and I'm not going to do a big speech on math, but it's based on your discretionary income. So to find your discretionary income, they take your adjusted gross income from your most recent tax return, and they subtract 150% of the federal poverty level. So basically, the more you pay, the more you make, the more you pay. It's designed to be affordable. If you're making less than 150% of the federal poverty level, you're paying $0 per month. And when I say that, I mean you're paying $0 per month. You're not actually sending a payment, but you're actively in repayment, and that's counting towards public service loan forgiveness in a way that a deferment or a forbearance would not. If you, let's say you change positions and you're now making less money, or for some reason your most recent tax filing doesn't reflect your current income, you can use 2 recent paychecks to document your income. But because so much of this is going to be based on your most recent tax return, it's a really good idea to think about your student loans and tax season. Real quickly, anything that's an above the line deduction will save you money on your student loan payments once that AGI goes into the equation for determining how much you pay for that year. So if you're contributing to a traditional IRA, you're making 401k contributions or HSA contributions, that's lowering your AGI and lowering your student loan payments. But keep in mind, not all deductions are above the line. For example, mortgage interest will not impact your student loan payments. Now, there are 5 different income-driven repayment plans that I'm going to cover. These plans I'm going to cover chronologically because it's the easiest way to understand the differences between them. The first income-driven repayment plan is called income contingent repayment. With that, you pay 20% of your discretionary income. You do it for 25 years and you get IDR forgiveness. Notably, this is the only IDR plan that you can use for Parent Plus loans. All of the other new and improved plans you can't do with your Parent Plus loans, if you have any. Next up is the income-based repayment plan. The required payment drops to 15% of your discretionary income, but it still takes 25 years for IDR forgiveness. Pay as you earn. Now things are really starting to improve. You only have to pay 10% of your discretionary income and you get IDR forgiveness after 20 years. Unfortunately, this plan is only available for new borrowers who borrowed their first loan after October of 2007. Now, to fix this issue, the government said, well, we need to make a 10% plan available to the borrowers who had older loans. This is where revised pay as you earn enters the discussion. 10% discretionary income. And now that bullet says 20 or 25 years for IDR forgiveness. It's 20 years if you only have undergraduate debt. It's 25 years if you have graduate debt. The big highlight for revised pay as you earn, and this is something that pay as you earn doesn't have, and none of the other IDR plans have, is there's a very generous interest subsidy that comes with revised pay as you earn. Now, that interest subsidy enters the discussion if your monthly IDR payment is less than the interest that your loan generates. So let's say your loan's generating $300 of interest per month, but your IDR payment on repay is only $200. Your balance is actually growing by $100 per month. Now, that $100 is not immediately added to your balance. That comes when you have interest capitalization, which I'll talk about in a little bit. But if you're enrolled in revised pay as you earn, instead of having an extra $100 added to your balance each month, it gets chopped in half and it's $50 per month. So the idea here is that if you have a very large balance and a low monthly payment, revised pay as you earn can help prevent your loan from spiraling out of control because of the interest. Then we also have income-based repayment for new borrowers. And it's essentially pay as you earn, only now we're calling it IBR for new borrowers, and it's only available for new borrowers as of July 2014. So we've got 5 different plans that all sound like income-driven repayment, subtle differences between all of them. And I'll talk about some of the other differences in coming slides, but know that just because the plan charges 10%, it's not necessarily better than a plan that charges 15% or 20%. And each of these plans is going to have different eligibility issues. The other thing to keep in mind, IBR for new borrowers came within the last couple of years. Revised pay as you earn 5 or 6 years ago, that came into existence. They're currently in the rulemaking process for a expanded income contingent repayment plan. Who knows what's going to happen with that? The moral of the story is keep an eye out for new repayment plans that could potentially help your monthly bills. The plans charging 10%, like I said, may not be the lowest monthly payment. Different factors in your personal finances and your life may impact things. The studentaid.gov repayment estimator is a great way to look at all the different IDR plans. One thing it's kind of missing is it does not do a very good job of articulating the value of revised pay as you earn. If you are a younger borrower and you have the option of multiple plans, a lot of times revised pay as you earn might be the best option. Things to keep in mind. If you are married, you can file your taxes separately. And the advantage to filing your taxes separately is only your earnings will impact your IDR payment. If you file your taxes jointly, it's going to be your earnings and your spouse's earnings. However, filing separately is only available for certain IDR plans. For example, IBR and pay as you earn, you can file separately to get the lower payments, but revised pay as you earn, you can't. If you and your spouse both have federal loans, I'll just say the math gets complicated. In many cases, if you both have federal loans, go ahead and file jointly. Sometimes it makes sense to file separately, even if you both have federal student loans. That's a rabbit hole we could spend a whole hour on. Just know that that issue is out there. The repay subsidy, I already talked about that. And it's pretty easy to tell if your interest is bigger than your monthly payment, repay is a huge advantage. ICR does have, it's the worst of the income-driven repayment plans, but it does have this little alternate calculation method where they look at what it would cost to pay off your loans over 12 years, and then they do an adjustment based on your income. Here again, the math is a bit complicated, but if you're someone who's worried that by the time you get to year 9 of your PSLF plan and IDR might not make sense anymore, the ICR plan might kind of swoop in and save the day for that last year. One thing to watch out for is interest capitalization. Like I said earlier, your loan is generating interest each month, but it doesn't get added to your balance each month. And your payment can be lower than the interest that's generated each month, which means you've got all this extra student loan debt that's kind of floating off to the side. The good thing about it floating off to the side like that is you're not getting charged interest on that accumulated interest. The bad thing is it's kind of hard to track, and things can happen to cause the interest floating around up here to get added to your principal balance, and now you are paying interest on that interest. Department of Education calls that interest capitalization. Sometimes it's unavoidable. If you change repayment plans, if you consolidate, your interest will be capitalized. Other times it is avoidable. The classic example is the people who miss an IDR certification deadline. You have to certify your income on a yearly basis. Now, they will send out a reminder, but it's possible you miss it. So, calendar a reminder, do your income certifications each year at tax time so you don't forget. Whatever it takes, don't miss that yearly deadline, because if you do, you technically leave IDR repayment, you get bumped back onto the standard repayment plan, you've changed repayment plans, and now all that interest capitalizes. If you want to sign up for IDR, if you want to recertify, if you want to have your IDR payment recalculated because your income dropped, you can do that all on studentaid.gov. It's a very easy process. This is one instance they do a very nice job with the process. All right, student loan forgiveness. The IDR forgiveness that I talked about that can take 20 or 25 years, and public service loan forgiveness, which I know many of you are most interested in, those are the two most popular kinds. But we do have other options. There's the borrower defense against repayment. If your school closed, you could get some relief, and there's also a death and disability discharge. And before I get into all the forgiveness rules and strategy and things like that, it's worth pointing out that forgiveness isn't always the best option. If you're jumping through all these hoops to get a little bit of debt forgiven after 10 years, you might be better off just paying off your loans as quickly as possible, stopping the bleeding from interest, and moving forward. That's something you need to consider. Now, if you're staring at this mountain of debt, you have no idea how you're ever going to pay for it, forgiveness is probably the best approach. But if it's not clear that there's going to be a benefit to getting forgiveness, you might be better off just paying it off as quickly as you can. A couple highlights on the income-driven repayment forgiveness before we jump into PSLF. There's no employment requirements, and part of the reason I'm covering all of this is, some of you might go the private firm route, some of you might, hang a shingle and start your own business. IDR forgiveness is still on the table. So even if you leave a PSLF eligible job, there is this alternate route. And you're allowed to switch plans. You don't have to stay on one plan for all 25 years. You can bounce around as your finances dictate. This used to be a taxable form of forgiveness. Right now, there is a temporary break in the taxation of IDR forgiveness, but that legislation expires in 2026. I think it's probable that that legislation eventually becomes permanent or keeps getting extended indefinitely. It's really bad policy. Everyone seems to agree on it, but nothing is certain, especially with our government. So keep that in the back of your mind if IDR forgiveness is on your radar. All right, public service loan forgiveness. You have one goal: get 120 certified payments. Once you hit that 120, you've done your job, your loans can be forgiven. Those 120 payments do not have to be consecutive. If you're in your public interest job, you leave for a couple years, you realize, wow, private sector sucks, and then you come back to a public interest job, you can pick up where you left off. For a payment to be certified, there are three basic elements. First, you must be working full-time public interest work. If you occasionally do some pro bono public interest work or something like that, that's not going to count. You need to have an eligible repayment plan. And that's where I talked about the balance-based plans. Those don't count. Although, spoiler alert, we are going to talk about some limited programs that can possibly get those previous payments to count. And then you also have to have an eligible loan. And this doesn't mean all federal loans are eligible, private loans aren't, but only certain federal loans are eligible. So we'll talk about that loan eligibility element as well. And by statute, PSLF is not taxed. All right, so if you're wondering, am I eligible for public service loan forgiveness? Early on in the pandemic, the Department of Education made this tool called the PSLF Help Tool. It's excellent. Basically, you add your employer's identification number, the EIN that you see on your tax forms and possibly pay stubs, and they'll pull it up and they'll say, your employer likely qualifies or an employer does not qualify. One thing to keep in mind, if you see likely ineligible, all that means is they haven't seen anyone from your exact employer. I don't like the likely ineligible description because it makes it seem like you probably won't. But if you're the first person at your office to apply for PSLF, nobody else has, you're going to see the likely ineligible warning. Don't panic. Question?
Yeah, question, Michael. I think it's relevant to this. We did have someone in the chat who asked if there's a list of participating nonprofit organizations that are included in the program. And I'm wondering if this tool is really the best option if there is no list.
There isn't a comprehensive list. As long as you have, if it's a government agency, it's going to be eligible. If it's a 501c3, it's going to be eligible. And beyond that, this is where that list is really going to come in and make a big difference. But the potentially eligible employer list is just massive.
Got it. Thank you.
You're welcome. But we're talking about employers here. Your job description doesn't matter. The example I like to use is the emergency room doctor. If you're an ER doc for a nonprofit hospital or, at the VA, you're going to be eligible for public service loan forgiveness. If you're that same exact job, but at a for-profit hospital, you're not going to be eligible for PSLF. So, no matter how much of a public service you are doing with your job, it depends on the structure of your employment organization. Another common misconception is people think, well, I have to apply for PSLF. There's not a PSLF per se application where you get admitted into the program and then you start your count. It doesn't work that way. All you're doing is you're certifying payments that you make towards PSLF, towards that 120. Technically, you could do all 10 years of public service loan forgiveness or all 10 years of payments for your public service employer and not say anything to the Department of Education and then apply at the end and get your 120 and get your balance forgiven. I don't recommend that, but you can. Couple thoughts on certification. Please do it yearly. It's much easier that way. You know, if you change employers, certify, get in a routine of doing it every year, because the situation you want to avoid is you stopped working for this place 4 years ago and they've had high turnover. Everybody's different. How do you prove that you worked there 4 years ago? Don't let yourself fall into that situation. Apply, send in that certification yearly at minimum. The other big advantage to this is it's going to help you identify issues. If your loans aren't eligible or you're on the wrong repayment plan, this is where you're going to see that issue first pop up. A lot of people worry about the long-term viability of the Public Service Loan Forgiveness Program. Now, I don't have a crystal ball. I can't say for certain that it's going to be there. But I can say I have a high degree of confidence that it will be around 10 years from now, if that's how long it takes you to get to PSLF. There are several protections in place that bring me to that conclusion. First, PSLF exists by statute. This isn't, you know, some executive order that created this program. To get rid of PSLF, it would take an act of Congress. You know, and politically, student loan borrowers, I think, are really starting to flex their muscle. It's a group of over 40 million people. So getting rid of this program would be hugely unpopular. And let's also keep in mind that all the legislative aides working in Congress, they're government employees who just got out of Congress and they want PSLF. So, you know, we've kind of got built-in inside men protecting the PSLF program. The other big protection is PSLF is written into the student loan contract you signed, the master promissory note. So even if they were to eliminate the program, you've still got this contract that you signed with the government. Now, you know, we'll skip the government contract law discussion, but I will say this is the one detail where anytime I've seen a proposal to modify or reduce or eliminate PSLF, it's always forward-looking. Those of us that are currently in repayment are not impacted by that. And again, all this could go out the window and PSLF could get eliminated, but I think I have a high degree of confidence that this program will continue for all of us. All right, now we need to talk about federal student loan types. Not all federal student loans are eligible for public service loan forgiveness. However, these loans can potentially be consolidated to become eligible for public service loan forgiveness. The example that many of you may have are FFEL loans. They stopped issuing FFEL loans around 2010. So if you finished law school, you know, in the early 2000s or before that, there's a really good chance you have FFEL loans if you haven't already consolidated them. Parent Plus loans are also not eligible for public service loan forgiveness, but you can consolidate them to get them eligible. But it's important you consolidate those separately. Question?
Yes, and I think it's relevant to this topic. Someone did ask in the Q&A for PSLF and the 120 payments.
Yeah.
Let's say someone has undergraduate loans.
Yep.
Then does public service, but then goes back for a graduate degree. Can that prior service count towards the graduate loans? So I asked this question to say, do graduate loans and undergraduate loans count? And if there's service that occurs sort of as a break in between the types of loans, does that affect their counting?
That's a great question, and it's a complicated question. The standard rule is that the PSLF payment count, that 120 tally that we're working towards, each loan has its individual count. So your undergraduate loans may have a higher PSLF count than your graduate loans do. It's not necessarily a one-time thing where it wipes out everything once you hit 120. Now, where it gets complicated is some of the temporary programs and updates that they're doing right now that I'm going to get to later on in the program. But because they're updating the IDR counts and the PSLF counts right now, there's a good chance that, you know, let's say you have a couple years of public service work counted towards your undergrad loans, but not towards your law school loans, that when that PSLF count gets updated in the coming months, it's all going to count. So really complicated situation, but it is possible.
Thank you.
All right, so consolidation. A lot of people think of consolidation as you're taking, you know, 1, 2, 3 loans and then combining them, and now you have this big loan that replaces the old loan. What it's actually doing is it's paying off your old loans and it's replacing them with a new loan. And this is significant for 2 reasons. 1, you don't have to consolidate all of your loans. And 2, you can consolidate just a single loan if you have an eligibility issue. And really, that is the big benefit to consolidation, is it fixes eligibility issues. By consolidating your loans, you may be able to access new IDR plans. For example, I consolidated my federal loans when they announced the revised pay-as-you-earn plan. I had FFEL loans. Those loans were not eligible for this new revised pay-as-you-earn plan, only IDR. I wanted 10% rather than the 15% payments. So I consolidated, and the new consolidated loan was eligible for the revised pay-as-you-earn. It can also make debt eligible for public service loan forgiveness. Parent Plus loans fall into this category. FFEL loans fall into this category. Also, there's one other benefit to consolidation. If you have a federal loan that is over 20 years old, it's possible that that loan actually has a variable interest rate. They stopped doing variable rate loans about 20 years ago. Everything since then has been fixed rate. But if you consolidate your old variable rate loan, you can lock in a fixed rate. Notably, consolidation is designed not to impact your interest rates. So they take the weighted average of all your existing loans so that, you know, your student loans are generating the same interest. And what they're doing is they're rounding it to the nearest 1/8%. So it can have a slight impact, but interest rates should not be the driving motivation for any sort of consolidation. Now, the default rule with federal loan consolidation, and you may see this in some of your research, is that consolidation restarts your forgiveness progress. And that is the standard rule. And, you know, in 2023, when I'm giving this discussion, I'm going to warn people, think twice before you consolidate your loans, because you're going to restart your progress because it's a brand new loan. We've got some special rules in effect right now that make that statement kind of untrue. And I will get to that in a bit. The big mistake to avoid with federal consolidation is if you've borrowed a Parent Plus loan to pay for your child's education, and this is only Parent Plus loans. Graduate Plus loans do not have this issue. Parent Plus loans have limited repayment plan options. The best IDR plan for a Parent Plus loan is ICR. If you put a Parent Plus loan and a consolidation loan with all your other loans, then that combined debt can only sign up for ICR. So it could be a pretty costly mistake. And the worst part is, once you consolidate your loans and it's finalized, there's no undo button. There's no way to go back and say, shoot, I made a mistake. Can we fix this? The answer is no under the current rules. Question.
So I want to make sure I understand this for someone who did ask in the chat. So,
Okay.
Can PSLF apply to Parent Plus loans or no, from what you're saying?
It can. But the only route is going to be through the income contingent repayment plan, which has the higher monthly payment. So if you have Parent Plus loans and you have other student loans that also need to be consolidated, you can do 2 separate consolidation loans. There's no, consolidation is not a one-time option. So you could consolidate your FFEL loans into one direct consolidation loan, and then you could consolidate your Parent Plus loans into another consolidation loan.
Just
And that
don't
would be the
consolidate them
advised route.
together. You just don't want to consolidate them together.
Exactly. Because if you combine them all together, the Parent Plus loan is kind of a poison pill, and it limits your options for all of your debt as opposed to just some of your debt.
Got it. Thank you.
Hopefully all that discussion kind of illustrates the point that consolidation is not something you want to mess up. Work with your loan servicer on this one, make sure the right loans are included, discuss repayment plan eligibility and strategy. And once you submit your application to consolidate, and you can do that through studentaid.gov, you can also send in a paper application. They will send you final documents to review. And if everything looks good, you don't have to do anything. If there's an issue, you've got a small window, I think it's like 30 or 60 days, where you have to act to stop the consolidation before it becomes permanent. One last note, when you consolidate your loans, it's possible you're going to have a ton of student debt on your credit report. When I consolidated my loans, my old student loans showed up, the new consolidated loan showed up, and my federal debt doubled. And that was a stressful moment. Let's leave it at that. Don't panic if you see that. I get emails probably 2 or 3 times a week from people panicked about that exact issue. It happens. The one time to really keep this in mind is if you are about to buy a house or something like that and you need a pristine credit report, know that the consolidation process might cause a few headaches. All right. Now for the temporary repayment plan or temporary programs that are in effect for a limited period of time. Part of the reason why I asked to do this presentation as early as possible is because one of those programs ends in October, and I want to give you guys plenty of time to think about how it could impact you and have the option of taking advantage of it before that deadline arrives. I know you've probably heard things on the radio or gotten junk mail or spam emails about temporary programs, you must act now, or phone calls or text messages about urgent action required, or you're going to miss out on public service loan forgiveness. These have been routine scams that have gone on, certainly throughout the decade of my time in student loans. Normally, that is a glaring red flag that you're dealing with a scam, just ignore it. However, right now we have 3 different temporary limited federal programs that you do have to act now. So I'm going to highlight those for you. There's the temporary expanded public service loan forgiveness program, the limited waiver on public service loan forgiveness, and the IDR payment count update. We'll take each one of those one by one. The first relief program that came into effect was the TEPSLF. And Congress passed this legislation in response to the initial 99% rejection rate on PSLF applications. Everybody was getting turned down, and it was a major issue. And to fix the problem, they passed this legislation. And basically what it does is it allows people who may have been on the wrong repayment plan to still count their progress towards forgiveness. So if you were on the graduated extended repayment plan for 5 years and working public service, Under the rules, that time does not count. Using TEPSLF, that time may now count towards public service loan forgiveness. This was an issue that a lot of people had that contributed to that 99% rejection rate. And it was something that had to happen because a lot of people were calling into their servicers saying, hey, I want to qualify for public service loan forgiveness. I'm working for the government. Is there anything else I need to do? Servicer says, yeah, keep up the good work. You don't need to do anything. And this was a big reason why we saw that Navient lawsuit brought by the Consumer Financial Protection Bureau. When TEPSLF first started, there was a separate application that was required. And it was even more convoluted than that because you first had to send in a PSLF application, get rejected, and then once you got rejected, then you could apply for TEPSLF. They've since streamlined all of that. Now the employer certification, the PSLF application, the TEPSLF application is on one document. And even if you say, I'm applying for PSLF and what you really should be picking is TEPSLF, they will correct it for you. So it's all one document. You don't have to worry about that. Like I said, it fixes repayment plan issues, but one of the shortcomings here is it doesn't award partial credit. So let's say you had those 5 years of an ineligible repayment plan, you want TEPSLF, you can only take advantage of this program if those 5 years are going to put you above the 120. If it is only going to get you to say 100, you can't use TEPSLF yet. Another shortcoming is they allocated $700 million for this program. Once that money runs out, the program ends unless they allocate more money for it. As of April, which is when I saw the last update, $283 million have been used. Now, this program has been in effect for several years, and I'm hopeful that between this and the limited waiver, which is the next subject I'm going to cover, hopefully that 700 million is enough to cover everybody who needs it, because this program certainly has limitations that we've seen, and the limited waiver, which is the next subject, is a bit more broad. The Department of Education started the limited waiver in, I want to say September of last year. It might have been October 1st of last year, to help borrowers qualify for PSLF. And they were able to create this program using the CARES Act authority. This CARES Act was some of the pandemic related relief. Because it's limited authority, the program ends October 31st of this year. And there's some debate, but I don't think that an executive order can extend this program. I think it will require legislation, which means that October 31st is kind of a hard end, as opposed to some of the other relief where we've seen it get extended, 4 and 5 months at a time. So this limited waiver, if this potentially applies to you, you've got a hard deadline, get on it. The great thing about the limited waiver is it addresses repayment plan and loan eligibility issues. So if you've been listening to the first 45 minutes of this presentation and thinking to yourself, I have FFEL loans, I had no idea, I wasted all this time, take a deep breath. You've got the limited waiver. You can now consolidate those FFEL loans, and payments made prior to consolidation can count towards PSLF. The one big limitation of the limited waiver is Parent Plus loans don't count. All these perks of the limited waiver don't apply to Parent Plus loans. If you want to take advantage of the limited waiver, get a PSLF application on file and employer certification. And if you need to consolidate your loans, get them consolidated before October 31st. And the big deal here is if you consolidate, payments made prior to consolidation can count towards PSLF. Question.
Yes, and I want to make sure, I might not understand the question very well, so I'm just going to read it out loud, and I hope
Sure.
you do. So in regard to the limited PSLF waiver, if you are credited for some payments that didn't count prior to the waiver, does this carry over after October 31st? It said, this person says, I won't have enough credits to meet the 120 payments, but I'm hoping to at least get some additional payments.
Yes. Yeah, that's a great question, and I should have been more clear. The TEPSLF is the only one where it's an all or nothing thing. The limited waiver, if you've got 5 years, but you still need 2 more going forward, that's fine. You can consolidate, get those 5 years, get your count updated to 80 or 90 payments, and then continue on, your quest towards 120.
And the second question about the limited waiver, if somebody consolidated, way back when they originally had their loans and before they started making their payments, is all that they need to do now to be considered for the limited waiver is just to complete the PSLF application?
Yeah, and even if they submitted an employer certification years ago, I mean, a large group of this audience may not have to do anything. If you've already consolidated, you've already submitted a PSLF application, that's enough to trigger a review of all those prior payments of all that previous activity.
Awesome. Thank you. In the chat, you're getting a lot of thank yous. That was very, very helpful.
Glad to hear it. All right, then the last thing happening right now is an IDR payment count update. And again, I know most of you are worried about PSLF, but I'm mindful of the fact we've got over 100 people here right now and more who will be watching. Some of you aren't going to stay in public service long enough. So be mindful of the IDR path to forgiveness. And specifically with this IDR payment count update, the Department of Education is basically going back and cleaning up the mess caused by poor servicing. So servicers would often steer people towards a forbearance or a deferment when they could have signed up for an IDR plan and gotten a $0 per month payment. So to fix that, lots of things that normally don't count towards IDR forgiveness will now count in the updated count. So going forward, these things still won't count, but looking back, some of that time will count. So if you had a deferment other than an in-school deferment, that time will count towards your IDR forgiveness. Some forbearances will count. If you had a 12-month forbearance or a total of 36 months of forbearance, that time will count towards IDR forgiveness. All repayment plans made all those payments made prior to this moment will count towards IDR forgiveness. So if you were on the standard repayment plan for 2 years, those 2 years are going to count towards your IDR forgiveness. Taking advantage of this update is, again, it's something that happens automatically. They will start a review and go through every borrower's payment history. The one exception is if you have FFEL loans. Those are federal loans, but they're held by an outside organization. If you want to take advantage of the IDR payment count update, consolidate. And the deadline on that is not a firm deadline. They say the IDR payment count update will happen in January of 2023. That could get pushed back, but if you're someone who needs to consolidate, especially with the limited waiver, get it done before October. All right, now the payment and interest pause. I really thought I was going to be updating this slide to say, yeah, it got extended until January of 2023. Right now, it still ends August 31st of this month. I don't think it's going to end August 31st of this month. I mean, politically, it really doesn't make sense for the Biden administration to do that. There's also like the big telltale sign is servicers have to send out the monthly bills 1 month in advance of when the payment is due. And right now, people technically have payments that are due on September 1st or September 2nd, but the Biden administration already told them, don't send those notices out, which is, that's the wink and a nod to tell us it's getting extended. A lot of big companies in the student loan business seem to think the general consensus is that we're going to get it extended again until 2023. If you're kind of planning your finances, I would, and me personally, I have student loans. I'm planning on starting repayment in 2023. Could be a little bit earlier, it could be later. It technically could be next month. But that is my best guess based on the information available right now. An important detail to this payment clause is all this time that you're working and you don't have to make payments, it's still counting towards your public service loan forgiveness. It's still counting towards IDR forgiveness. Another thing to keep in mind is servicers are not going to be able to handle the restart. It is going to be a mess. There's no way around it. It's going to be a disaster. Servicers are already expecting to get more calls in that first month than what they normally get in a year. That's already a big problem, but these are the same servicers that cut staff during the pandemic and they haven't had to hire more. Even if they do staff up in anticipation of the restart, the people you talk to may have limited training. What does this mean for you? If you have questions, if you're going to consolidate and you want to talk things through with your servicer, do it well before the restart. Another thing to kind of keep on your radar, that $10,000 forgiveness that's being discussed, it's probably more likely than not that it happens. I don't think we're going to see $50,000 of forgiveness. It may be means tested, meaning, if you're earning above $150,000 per year, you don't get that 10K of forgiveness. But as you're trying to figure things out, that's something to keep in mind. They have said that there will be some sort of announcement on this before the end of the month is over. So you really don't need my speculation on that. You'll get something definitive in the coming month. All right, last subject, private student loans. There's no forgiveness on those. So the strategy for repaying your private loans is going to be different. A lot of people choose to knock out the loan with the highest interest rate. From an accounting perspective, that is the best way of doing it. Some people like to eliminate the small balances and get those easy wins. However you want to do that. But especially if you're chasing or even considering public service loan forgiveness, knock out those private loans before you work on the more generous federal loans, even if the federal loan has a slightly higher interest rate. One shortcut for the private student loans is you can refinance the debt with a student loan refinance lender. And what that does is it gets you lower interest rates, which saves you money. And you can also potentially get a longer repayment plan, which lowers your monthly bill. The big thing to keep in mind there is don't refinance your federal student loans. Once you refinance your federal student loans, that's now private debt. There's no way to undo that. With private loans, though, refinance them multiple times. If you can save money, go ahead and do it. Unlike a mortgage where refinancing it, there's transaction costs. The only transaction cost to refinancing a private loan is, the 10 or 15 minutes you take checking rates. The downside here is it's only available to borrowers who have, certain income levels and credit scores. And if you're interested in refinancing, this is just a very short discussion on it. If you go to Student Loan Sherpa, I've got far more in-depth guidance and analysis on that. And it's now 1 o'clock. Question.
That was awesome. We have lots of questions. So if you are ready for questions and answers, I can start throwing them out at you. I'm not interrupting by coming on now. Whenever you're ready, there are a lot of questions in the chat.
Okay. I didn't know how long this presentation was going to take. I had a couple items of kind of filler just in case, because I want you all to get your CLE credit. We're not going to need that. I'm happy to discuss these items in the Q&A. But yeah, let's jump into it.
All right. I'm going to start with a comment. Someone just said in the chat, and I'm glowing ear to ear, this is the best training I've ever received on this issue. And a huge thank you to Mr. Lux and our training initiative. So I'm going to start off with that because that made me feel really good.
Thank you very much. I've been talking into the void for the past hour. I'm used to seeing people's faces and, kind of responding and getting some feedback, even if it's nonverbal. And I'm just staring into a green dot. So thank you very much. I appreciate that.
I know I feel the same way about the vortex, but the folks are here and the folks are listening. I'm just going to go up to the top because, like I said, there are a lot of questions.
Okay.
The first one that I see here in the chat is about amending the PSLF application. So in this person's original pass, they didn't recognize a period where they worked 30 hours a week as a death penalty lawyer. It was part-time according to the employer, but it looks like it should be considered full-time under the regs. This person did send an amendment to try to get them to reconsider, but hasn't, basically no traction, and is wondering what can be done.
The tricky part about that one is the regs do say it has to be at least 30 hours a week to qualify as part-time or as full-time, but they also say that the employer has to consider it full-time employment. So if you're working 32 hours a week and the employer doesn't consider it full-time, then it's not going to be full-time for purposes of PSLF. Now, that being said, keep tugging at that thread, send in an application, file a complaint with the Consumer Financial Protection Bureau that they're not counting this and it should count. Write to your member of Congress, like, if you make some noise, you might be able to get that to go through. I've definitely, seen some inconsistencies over the years, and you might be able to get that time to count, but there is an issue, and it's not necessarily going to be easy.
Got it. Thank you. Next question. So if you made more than 180 qualifying payments, I'm sorry, 120 qualifying payments, how long does it take after your loan has been forgiven before your excess payments are remitted to you? Oh, that's a very interesting question. So if you made more than what you had to make, do you go through a separate process to have those remitted? And are those excess payments subject to income tax?
Great question. And oversight on my part, I definitely should have had a slide on refunds for those, but we can cover it now. Short answer is it really depends. You will get that refund if you're eligible for it. Some people, I've seen people get it in a period of weeks. I've seen other people where it takes months. When they first started doing it, they actually issued a check for each and every extra payment. So people would go to their mailbox and have like 30 checks from the Department of Education on their extra PSLF payments. They're now sending it in one check, but the times are all over the place. All this stuff is going on. My advice would be to keep on it, but don't panic. And as far as taxability, that should not be taxed. That is a refund of prior payments. That is not income.
Got it. Next question is, and I'm jealous of this person if they're already here. What do you do once you've made the 120 payments?
Well, once they're certified, you wait for those trophies to show up on your payment portal, and then you wait for the balance to drop to zero, maybe a refund check. And that's really it. I mean, as long as you've submitted all the necessary employer certification forms, there's not like a final application or, a special dance or anything that has to happen to other than just waiting for it to be finalized.
Got it. All right, next one. Are you penalized? And I'm sorry, I don't know if you answered this one. Are you penalized for switching between pay and repay midstream?
Not really. It won't impact your progress towards IDR forgiveness. It won't impact your progress towards PSLF as long as you're sending in your employer certification forms. The one potential penalty would be in interest capitalization. So if you have, if you've been making small payments and your balance has a lot of that excess interest that hasn't been added to the principal, changing repayment plans will cause that capitalization. That's the closest to a penalty I can think of.
Okay. And I'm sorry, bouncing back to remitted payments, is there a cap on the amount of excess qualified payments that can be remitted?
Nope.
Okay, even after, it says even after loan forgiveness, so that it doesn't change anything.
Well, that if you so under the limited waiver, a lot of people are now qualifying. And if you qualify under the limited waiver, they will issue a refund for potentially years of payments. However, if before the limited waiver happened, you had your loans forgiven. So like, let's say you had your loans forgiven in 2019 under PSLF, and you were one of the early ones. If you're in that category and you're like, wait, I have all these extra payments that I made that would have counted under this, they're not reviewing the people who are already out of the system and already forgiven.
Got it. Next question. We're getting through them. What if you haven't made any payments because you've been in deferral, but you've worked in nonprofits for the past 10 years?
You've been in deferral for 10 years?
I guess that's what the question's asking, even though the person's worked in nonprofits.
I would say send in an employer certification right away. If you need to consolidate. And I mean, technically that should count under, these new programs. The one that doesn't count, and where I thought this question was headed, is when you finish school, you have a window before repayment starts. They call it a grace period. The grace period doesn't count towards any of that.
Got it. So this person should definitely do any consolidation and submit employment certification before that October 31st date.
Correct.
Got it. So also for the limited waiver, do payments during forbearance and deferment count? And I'm not sure if I understand, because when you're in forbearance or deferment, you aren't making any payments. So I guess the question is if you are in forbearance or deferment and you don't make a payment, will you be credited for those time periods through the limited waiver? Potentially.
Making extra payments, and this is just kind of a blanket rule, making extra payments does not help. When I've spoken to a lot of people who, they qualify for $0 payments and they worry that, it's a $0 payment, it's not going to count. Can I just pay $5 to make sure that this time counts? Paying $5 doesn't help you. Now, the time during the payment pause that, we've all been enjoying for the past couple of years, that time does count and you don't need to make a payment. And if anybody listening has been making payments during that time, you can ask for a refund on the payments you made going as far back as March of 2020. So if you have been paying extra in the hopes that this is going to get you closer to PSLF, there's no reason to. I would say ask for a refund. As long as the payment pause is still going, you can ask for a refund for all those extra payments. So definitely take advantage of that.
Got it. And I think you just answered the next question, which is someone asked, do you recommend if you're close to the 120, do you recommend coming off the pause and just paying to meet the 120? That answer is no, because basically you are being counted for your during the pause.
Yeah, you're making progress towards it.
Okay. Is there an application for IDR forgiveness?
That should happen automatically. It's tricky because the IDR plans are so new that we really haven't had many people who got to the 20 years. That should happen automatically with the IDR payment count update, but I can't say for certain on that. That's a great servicer question because, individual servicers may even have their own policy.
All right, we have a few more. Whenever if you need to drop off, Michael, you let us know.
No, as long as there are questions, I'll stick around.
We appreciate it because there certainly are more amidst thank yous and wonderfuls. There are more. The next question is, with a loan involved in the TEPLSF process and a message stating that the account is still under review, is it best to wait for the review or call the servicer or DOE for an issue, especially if this means the loan could be forgiven?
It never hurts to call. It never hurts to press the issue. They've got so many different processes happening at the same time. Certainly push the issue. I mean, right now, if you're hoping for TEPSLF, then that only helps a portion of borrowers, where the limited waiver helps an even bigger portion of borrowers, and maybe even more beneficial. So if TEPSLF is on your radar, I would encourage you to dig into the limited waiver and see if that's not potentially even better. And then work with your servicer to make sure that's all being considered.
So somebody else asked if there was a wrong payment count, if the payment count they provide is wrong, is there an appeal period or a time frame that you have to address that?
I'm not aware of any statute of limitations. The tricky part is proving it. I mean, there are a few different ways you can go about that. First, working directly with the servicer, to the extent you can, make a record of payments you've made and track all that, by all means do that. If your servicer still isn't working with you, one of the great resources for borrowers is filing a servicer complaint with the Consumer Financial Protection Bureau, because that almost always triggers a servicer response. And the people responding to those CFPB complaints are kind of higher up in the organization and empowered to do more, and certainly able to correct errors if they see, oh, this is clearly an error based on this complaint.
Awesome.
You can also talk to the ombudsman of the various servicers.
So I'll take a second just to read a positive. This has been incredibly helpful. Thank you so much for taking the time to do this and guide us through sometimes confusing student loan forgiveness maze. Good luck, and may you all be debt-free soon. So right before that, somebody asked, and I think we kind of touched on it, but I think people get confused about the pause that we have going on and deferment or forbearance. And so somebody asked, can you explain more about being on deferment, and will zero payments count towards the 120? And I think that that's confusion with the pause, because we're paying right now. I'm not paying anything, but it's counting. But in the past, I've had to defer, and I'm not paying anything, and it doesn't count.
Yeah. So during the payment pause, it all counts. It counts towards IDR. It counts towards PSLF, and then the $0 payment also counts towards everything. They don't care the size of that payment when they're doing the payment tallies. So whether it's $0, $5, or $300, it all counts.
All right. So 3 more in the chat, and then I think 2 more in the Q&A.
All right.
Is consolidation required for PSLF in general, or just for the waiver?
I mean, the answer to that is neither. Consolidation is a necessary step for people who have certain loan types that are not eligible. Kind of a blanket statement: the longer ago that you finished college, the more likely you are to need to consolidate. The FFEL loans are a big one that I know a lot of us have. So if you were still in law school, in like 2010 or earlier, you probably have FFEL loans. You probably need to consolidate, and you may have already done that. Whereas if you're just now, you're fresh out of law school, you may not need to consolidate to take advantage of any of this.
Right. All right. So I love this question. It's interesting. What about employers who were for profit when you worked for them, but became nonprofits after you left? If you're trying to certify now, any hope for getting credits for those months under the new temporary rules?
Interesting.
It's a good question, right? Yeah.
Yeah. Well, I'm gonna take a cop out. I haven't seen this exact scenario before. My cop out answer is try it. Send in the employer certification, have somebody from that organization certify that you work there, they're a nonprofit employer, and see what happens.
All right. Be brave. Just do it. And then the last question in the chat, and we'll move over to the Q&A, is what payments are considered ineligible towards the limited waiver?
Payments that are ineligible. If you are in repayment, which would mean any repayment plan, it counts towards the limited waiver. So I'd say not any.
Yeah. All right, Q&A. Let's get through them. Math is complicated for both having federal loans. Where can I find a resource to make the calculation?
The short answer is you're going to have to kind of do your taxes both ways. File your tax, go into H&R Block or talk to your accountant or whatever tax software you use, see what it costs to file separately, because filing separately typically means higher taxes, and then see what it costs to file jointly. And then, you can use things like the repayment estimator to get a feel for what your monthly payments would be under the various circumstances. If you both have federal student loans and you don't have any kids, the majority of the time it probably makes sense to file jointly. As you add children to the equation, the math starts to shift, but it's really a case-by-case basis. But there is definitely a marriage penalty. There's no way around that.
And so I think you answered the next question. What if your spouse doesn't have any student loans? Does it matter how you file your taxes?
It does matter, yeah. You can file jointly for the lower taxes, but your spouse's income is going to count towards your IDR payment. And again, that's only for certain plans. For a revised pay-as-you-earn, it doesn't matter how you file your taxes. Your spousal income is going to count outside of a few very limited scenarios like abuse and things like that.
Right. Is there a tool or a way to see how many eligible payments I have?
Yes. Well, yes and no. So for public service loan forgiveness, you should be able to log in and see an updated tally in the portal. I know Fed Loan Servicing had that. I'm sure many of you are in the midst of a transfer from Fed Loan Servicing to MOHELA. That's where I'm at right now. Currently, I don't have loans anywhere because they're not at Fed Loan anymore and they haven't gotten to MOHELA yet. So I don't know what the MOHELA portal is going to look like, but that tally should be there. Now on the IDR side, that tally towards the 20 or 25 years, there's not really a good one yet. I suspect we're going to see one when they do the IDR count update in January of next year. Until then, you can always call your servicer, but take what they say with a grain of salt because there's a lot happening on that front.
The next one is a two-parter. It's from the same person, so I'll read it. If we consolidated before 2007, are we permitted to get credit for those payments? I was told that none of my forbearances credited and only payments after 2007 will be counted. How do I address this?
Yeah, the problem with payments before 2007, I'm assuming this is a PSLF question based on that date. Public Service Loan Forgiveness Program didn't exist until then. And so you can't get credits for payments that you made prior to the existence of the program.
That makes sense. And I think you answered this. Does temporary deferment count towards PSLF? I think the answer is no. If you defer and you don't make a payment.
Well, unless it's asking about the current payment pause, which is a temporary deferment, then that time does count.
Then that does count. Got it. All right. And this looks like the last one, other than a request for resources, is any word on who's going, and I think you said this at the end, any word on who's going to get to decide which loans get the 10K forgiveness if it comes?
I mean, you know, we can guess. Best guess, it's going to be couples under either 200, 250, or 300,000, and individuals under 150,000 as of their last IDR certification. I think it's going to be means tested. The problem with means testing is the IRS isn't allowed to give that information to the Department of Education. So it requires borrowers to take an affirmative step. And that's an issue because we've got a lot of borrowers with like a $7,000 balance who have completely left the system. And really, that's who the 10K forgiveness helps the most. And that's the argument for not means testing it. And I think that's the discussion that's happening right now and why we haven't heard anything final. But again, you know, I'm just reading tea leaves at this point. You know, we'll know definitive hopefully soon.
All right. And then the only other thing is, where can we find more resources on updated IDR counts and forbearances? So any resources that folks can poke around on would be much appreciated.
The Student Loan Sherpa website I find to be fantastic. I've been tracking that stuff and I talk about it when there are new updates. I mean, servicers should update borrowers. This stuff tends to generate major headlines. It's hard for me to, because, you know, I'm one of those nerds. I have a student loan news, Google News alert that I get emailed every day. Honestly, it's not a bad idea. It is hard to keep track of this stuff. One thing that I'm working on that isn't live on the site is doing a mailing list where once a month I'll send you an email saying these are the latest developments in student loans. This is what to keep an eye out for. If that's something that you're like, wow, I really want that, please let me know, and you know, I'll prioritize that. But yeah, I think, you know, and visiting the studentaid.gov website, you know, their updates. It's just one of those things. Keep your ear to the ground because it does change. You know, don't assume that you've got it all figured out and you don't need to do anything for the next 6 years because things will change.
Absolutely. And so what I'll do is a copy of this recording will be sent in about 24 hours through Zoom. The email will come from Zoom with the CLE code. And what I will do is I will put a link to the Student Loan Sherpa. That way folks can bookmark it like I have it bookmarked on my computer now and look at the resources that are there. And if there are any other resources that Michael has, he'll send those to me and I'll include that in the email as well. But I think we've held you long enough. I think that the questions were amazing. You really brought a lot of clarity to a place where a lot of folks are really confused and really scared and really just want to do the right thing and are trying really hard to get on top of something that seems like it keeps the mountain just keeps growing and growing and growing right in front of them. So I want to thank our audience for being so engaged, for asking the questions that even though you asked it, everyone else was thinking it and needed to know the answer to. And so thank you all for your public service. for the work that you do for the community. This is not all for naught. And thank you, Michael. Thank you for your passion, for taking the time and your patience, and really, really giving us some clarity in a really, really dark and confusing time for a lot of folks. And with that said, I don't know if you want to say anything to close out, and then I will turn off the recording and let you go to lunch.
Well, thank you very much for having me. It was a pleasure, and I hope I helped.
You definitely did. Absolutely. Well, you're getting lots of thank yous in the chat. You're a hero for helping us. I love that. Thank you, thank you, thank you. And with that, I'm going to stop the recording.
Thank you.